All right, so this is day 23 of my stock market portfolio journey to a $500,000 stock market portfolio. So I'm going to start with the equity in all my Questrade accounts. So first of all, my margin got an equity now of 88.18. I think during the day Friday, the equity dropped all the way down to 7,000, but it closed at 81.18. In my TFSA, I've got an equity of 55,512. And in my RSP, I've got an equity of 17,257. That's a total of 81,587. Don't know why those squares dropping hard. I bought it at 69 and it dropped all the way down to 58. If anything, I thought this stock was going to continue to go up. It's going to be a little bit hard to sell a call option after September 20th. So if you remember, I talked about this earnings trade on Broadcom, AVGO, placing it on Thursday and close it Friday morning. I had placed an order on Broadcom between 285 and 315, an iron condor. At the time, Broadcom was trading at 300. My order didn't get filled. I placed it for, I think, 95 cents and it didn't get filled. I think if I had placed it at 75 cents, it would have gotten filled. But this trade would have ended up being a little bit profitable because the next day, Broadcom was trading at, here, let's look at it. So it closed Friday at 290. So it would have been within my range. My options would have expired worthless. But for sure, knowing myself, I would not have waited till end of day. As you could see, it actually went outside the range throughout the day. It went to 284. So most likely I would have closed the trade early. And given that it went from 300 to 286, 288, 290, 287, it probably would have been a profitable trade, but a very little one. So if I collected, let's say 75 cents, I probably would have had to close it for maybe 30, 40 cents plus commissions. It would have been a very small profit. So not a big deal. No regret that my order didn't get filled initially. If I had enough guts and left the trade on until end of day, until expiration, would have kept the full profit of $75 because it ended up within the range of 285 and 315. But that doesn't always happen. It could have easily gone past 285. So yeah, anyways, I didn't end up making the trade because my order didn't get filled. So on Friday, I placed an iron condor on NVIDIA, as you can see here, expiring October 18. I went with strikes of 200 and 160. I think at the time, NVIDIA was trading at about 182. So as long as NVIDIA stays within 200 and 160 come October 18, I keep my full profit. But the plan, of course, is to close it early, maybe within 2 weeks. Now, next week, of course, there's the Fed announcement. So if things go down, then this NVIDIA is going to follow for sure. And then the value of the options are going to go up as well. So it might cause me some trouble next week, but I'll just wait it out. I still have time. Even if NVIDIA goes below 160 next week, I don't have to react, knowing that it's just going down because the general market is going down. And I'll just have to wait 3 or 4 more weeks and then the stock might slowly come back up above 160. So as long as it stays above 160 but below 200, I keep my full profit. I also closed out American Airlines, which was a covered call trade. I closed it early. And then I placed an iron condor on Netflix, although I don't like Netflix, but I picked a small width. So a 2.5 width between the strikes. So max loss is 250 minus the premium that I collect. The premium I collected, I think, was about $75. Here, let me just calculate it quickly. 262 minus 224 plus 299 minus 257. Yeah, so it's actually $80. So my max loss on this iron condor trade is 170. My max profit is $80. So it's a good risk to reward ratio. And I have until October 11, and I can always close the trade early if the trade shows profit. I also closed my Kroger trade early. So it expires next week, September 20th, but I was able to get, I think, 23.96 out of it instead of 24. So my max selling price on Kroger was 24 if I wait till September 20th. But I had the chance to close it today for 23.96. So it wasn't worth waiting an extra week for $4, right? So I closed it early, got my capital back. So now my buying power in my TFSA is about 17,000 Canadian, and in US it's 13,000 US. I want to make this following trade. So I'm going to wait till Wednesday, which is, I believe, the Fed announcement. If the market goes down, I want to buy 100 shares of the Qs. Here, the Qs right now is trading at around 192. So it's an ETF that tracks the big names in the NASDAQ. So Facebook, Apple, Nvidia, Activision. So let's look at the past year. So the Qs, the indexes in general is the one thing that you know for sure over time is gonna go up. Over time, the general market over time goes up. That's the general direction of the market. Like it or not, that's the general direction of the market. Short term, anything can happen. So my plan with my TFSA is to buy 100 shares of the Qs, but then sell covered calls every week on the Qs, wherever the price is. So for example, September 20th, let's say I had bought the Qs yesterday at 192.5, right? Could have collected $167 just by selling the call option that expires September 20th. So $167 divided by 192.5, 0.8%. But that's per week. So times 52, that's about 45%. Now, of course, every week I'm not going to get that exact return. But let's say I buy it at 192.5, stock goes up, I'm going to get my money back. Let's say it goes up to 194. I'm going to buy the Qs again at 194. The premium, the return will be much lower because when the stock goes up, premiums go down because there's less volatility. So let's say I collected 0.8% the first time, maybe I'll collect 0.6% the next time. But then let's say I buy it at 194 for the next week, then the stock comes back down to 193. Premiums will go up because stock went down, but I'm going to stick to the same strike price that I bought the stock at, right? So I'm going to have to stick to 194. But let's say the stock goes down to 180. In that case, I don't have to sell a 184 strike. I could probably sell a 190 strike because chances are that within a week, the Qs is not going to go from 180 to 190, for example. So my plan is to sell weekly call options on the Qs, regardless of where it's trading at. If it gives me a 25% return at the end of the year, I'm happy. But the idea behind it is the Qs will always go up. So even if I buy it too high and it drops, eventually it's going to come back up. Like I know it's coming back up. Not like a regular stock where, hey, it might never come back up. I was thinking of, instead of buying the Qs, it's just buying whatever the Qs is composed of, like Apple, Facebook, all these things. But I'm afraid to put so much capital, 100 shares of Apple or 100 shares of Facebook, and then Facebook drops to 140, for example. It's trading at 187 right now, Facebook. Premiums on Facebook would be much better. Weekly or monthlies will be much better than buying the Qs, but I'm concerned that if I buy it at 187, that's putting 18,700 in the Qs. What if Facebook drops to 150 or 160? Then I've got a lot of capital that's tied up because I would be afraid to sell call options at a lower strike on Facebook because I know that it could move easily. So then in that case, I'd be stuck using the same strike that I bought Facebook at, and premiums will be very low, and it's going to be a lot of capital that's tied up. Although I really like Facebook, I trust it, I think it's going to continue to go up, but I know it's very possible for Facebook to drop because it has happened twice already. But the Qs is composed of many great companies, so the only way that the whole ETF drops is if the whole market drops. And when the whole market drops, it just eventually comes back up. That's why I want to do covered calls on the Qs in my TFSA, because in my TFSA, I can't do credit spreads. I could only do covered calls. Eventually, I would like to do covered calls on the SPY as well, because they have expiration dates every 2 days, Monday, Wednesday, Friday. So for example, if I had bought the SPY at 301, could have sold, let's say, a call option at 301 strike, collected $65, but that expires Monday. So that's in 1 or 2 days. So 65 divided by 301 is 0.2%. But if you do that 3 times a week, that's 0.6% times 52, that's 33% per year. But because you have very short expiration dates, if the SPY goes to 290, you can easily pick a lower strike because you know that you only have 2 days. So the chances that the SPY goes above your lower strike is smaller. So that short-term expiration date really helps. So that's something that eventually I would like to do. Instead of owning Afria, instead of owning Bed Bath & Beyond, CHK, FCX, Grubhub, although Grubhub came back up as I expected, 66. Instead of owning Halliburton or IMGN or Mattel or Neo or Teva. So although individual stocks will have much higher premiums, sometimes I can make like 5% per month, but then I risk being down so much on the underlying stock. I mean, in my TFSA, only AMD is the only profitable one. The others are all down. Grubhub is recovering. Mattel is good as well. So Mattel, Grubhub, and AMD are the only good ones. And this trade on Bed Bath & Beyond. So I bought it initially at 14, but then I bought it a second time at 10. So the one that I bought at 10 is profitable, but the other one at 14 is not profitable. And even when I bought it at 10, Bed Bath & Beyond actually went lower. I think at some point it was trading at 8. So even the one I bought at 10 was going to be troublesome, but I think it recovered here. Let's look at 5 days or 1 month. Yeah, it was trading at 7.4. So that's why I want to stick to covered calls on ETFs. And look at the yield on Bed Bath & Beyond, 6%. That's actually pretty good. It's a good dividend player. So now I'm left with this American airline trade that closes October 4th with a 31.5 strike. So most likely I'm going to end up keeping it. I'll try to sell a call option against it. It'll be a smaller premium. I've got this Apple Iron Condor. I think Apple dropped. Yeah, Apple dropped Friday, 218. I have strikes at 207.5 and 232.5. So hopefully it should be good enough, right? By October 11 for me to keep my full premium. Actually, you can see right now that the trade is showing a small profit, but not enough to close it early, of course. Bristol Myers, I'll probably sell another call option. It's trading close to my strike of 50. Box, I'll be selling another call option, of course. My strike is 20, the stock is at 17.9, and it expires next week. Dell, I think I'll be getting my money back because the stock is trading above my strike of 52.5. This gold Iron Condor, I had a chance to close it Thursday for a very small profit, but I didn't. And now the trade is showing a loss because GLD is trading at 140.15 and my put strike is 140. So it's very close to my limit on the downside. So it's showing like a loss of about $20. But I had a chance to close it for a profit of about $15 on Thursday when it was trading at 142, 143, but I didn't. But I still have time. This one expires September 30th, so I have about 2 weeks. Goodyear Tire is a little bit troublesome because it's trading above my strike of 12, but my cost is 14.8. But hopefully if the market comes down after the Fed announcement, I'm sure everything else is going to come down. So maybe that'll fix my little problem here with Kraft Heinz and Goodyear Tire. Micron is showing a small profit, but still too early. My Iron Condor on Shopify, so my limits are 400 and 300. It dropped to 338. So maybe my 300 strike might get tested, but I still have time till October 18. Hopefully it just fluctuates between 300 and 400. I think the range is quite wide, but definitely my plan is to close this trade early as soon as it starts showing a decent profit. I don't like waiting till expiration because I know anything can happen and it's dangerous. So SNC is rallying back up. This stock was trading at 15 at some point. Now it's at 21. So it's a good thing I kept a strike of 22. And the reason I kept a strike of 22 is because I was able to collect something. I got $25. But on other trades like Kraft Heinz and Goodyear Tire, by sticking to the strike price of my cost, the premiums were so low. But with SNC, I guess because there was so much volatility, I was able to collect something out of a strike price that was safe according to my cost of 21.75. And it's a good thing I did because now it's at 21. So I'm safe. So come September 20th, the option should expire worthless. and I can sell another call option for the following month. Actually, let's just out of curiosity, just want to see what that could be worth. So October 18 at a 22 strike, I could collect $1. So pretty good. I think that's about 5%, 4%. Can't complain. I've got an iron condor on SPX. I think this one's gonna be a bit troublesome because my put side is 28.85, and for sure with the Fed announcement, this is gonna drop. So I'm at 3,000 right now. Call side is 30.85. So by October 18, I need the SPX to be below 30.85. I think that's safe, but to be above 28.85, it's also safe. But for sure next week something big is gonna happen. So it might drop below that number next week, but hopefully comes back above it by October 18. All right, so this was a quick overview of my stock market portfolio, day 23. So if you have any questions, leave them in the comment section below. Any suggestions as well. Like always, if you're gonna open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.